Hello and welcome to the FCC Economic Outlook 2023. Welcome to those who are watching this event live on January 24th, and if you're watching a recording of this event, thank you for joining us. I am coming to you today from Montreal, Quebec, and I do want to acknowledge that Montreal is the traditional and unceded territory of the Mohawk and Algonquin peoples. And it's a place that has long served as a site of meeting and exchange amongst nations. Wherever we find ourselves today in Canada, we are on traditional territories with rich traditions, stories, and histories that should be understood and honored. And it is our commitment in the spirit of reconciliation and collaboration to honor these people as vital contributors to our society and respect the diversity and strength of all the Indigenous people across this country. In the next hour or so, our FCC economists will review 2022 and, more importantly, provide a thorough discussion of the economic drivers that we should be watching for in 2023. We'll make sure to identify strategies that you may consider within your operation in response to those trends and risks in the operating environment that we will be discussing today. 2022 was an eventful year. I would say inflation was arguably the #1 topic and multiple factors were connected to the major inflationary pressures that we experienced. We can think of rising interest rates, high input costs, shifting consumption habits, to name a few. But there's also quite a bit of optimism. A few statistics that I find interesting is FCC estimates that the 2022 farm cash receipts will have gone up 14.1%, and the forecast for the 2023 cash receipts will be up another 4.6%. Food and beverage manufacturing sales are estimated to have increased by 11.3%, and the projection is that they'll go up another 5.7% in 2023. In short, revenues are up, but so are the costs. So speaking of projections, and to unpack all the different trends in the economy, let's hear from our economics team. Let me introduce to you JP Gervais, FCC's chief economist. I'd like to turn to you now, JP, and I'd like for us to discuss the overall state of the economy. So I just highlighted that inflation was a key disruptor in 2022. And I'll put you on the spot right away. I'd like for you to tell us, what do you think will happen with inflation in 2023?
Well, thanks, Darlene. Good afternoon, everybody. So, Darlene, you'll remember like about a year ago, exact same time, we started out this event talking about how we should not overlook and not underestimate the persistence of inflation. And guess what? You know, inflation has been elevated throughout 2022. And you'll see up on the screen pretty soon a chart that illustrates the trends in inflation, really. And what we're saying is that inflation is starting to come down, right? If you look on the far right, the dark black line there, it clearly shows that inflation's been coming down. Some of it has been the result of lower gasoline prices. And so we should not be too optimistic that inflation will come down easily and soon enough, right? I do think, and I'm confident that by the end of 2023, we'll have inflation heading towards the upper range of the Bank of Canada target, but I do think that it'll take a little bit of time. Now, food inflation, which we saw on the screen, is quite a bit elevated compared to where an overall inflation is, right? And we'll have plenty of time to talk about this, right? But if you look at the drivers of inflation, you think, for example, consumer savings and consumer spending, that will be coming down. Already has come down to some extent, right? Higher interest rates, slowing down consumer spending. If you think of supply chains, a big disruptor in 2022, a source of the inflation that we're seeing currently in the data. Well, I do think that supply chains, for the most part, are getting back to some sort of normality. I mean, we have some supply chains in our sector, in the ag economy, if you think of farm equipment, which are seeing still some disruptions. But overall, I do think that supply chains are mending, and that's, I think, a good thing. One source of inflation that is not changing, and we'll have plenty of time to talk about it as well, is the labor market, right? Wages up, and that creates quite a few inflationary pressures. So overall, confident that inflation will be coming down by the end of 2023, but it'll take time. It'll take the 12 months to get there.
So you mentioned, JP, consumer spending and consumer savings. And if I understand, I'd suspect that the slowing of the consumer spending is due to those high interest rates that we've seen in 2022. So what do you think is going to happen with the interest rates? A great question for 2023.
Yeah, well, a question on the mind of a lot of farm operations, a lot of businesses for sure. Question we get all the time, right? So let's just start by saying that tomorrow is the Bank of Canada decision, right? So not only a decision with regards to the overnight rate, their policy rate, but also a release of the forecast, updated forecast for most of 2023 and all of 2024. So we're going to get lots of information tomorrow. But today, and we'll know soon enough if we're right or wrong, but for now, we think that the Bank of Canada is going to lift once more the overnight rate by 25 basis points. And that will be the last increase we get as part of this cycle of higher interest rates that started out in 2022. That's going to be the last one in 2023. So we're done after this. But I think the bottom line is that we expect the overnight rate and short-term rates in general to remain elevated for most of 2023. So I would caution against something that I've heard, in the recent weeks, for example, that because we anticipate a little bit of an economic slowdown in Canada, who knows? I don't think the most interesting question is whether or not we'll get a recession. There will be a slowdown, and if we get a recession, it'll be different than the ones that we experienced over the last few years simply because the labor market's so strong. But because of the slowdown, don't expect the bank to respond to this by cutting back its overnight rate. So that's one thing. Second thing is if you look at long-term interest rates, and we'll see on the screen a chart that looks at different interest rates based on the bond market and really different terms for interest rates. And we've already seen that if you look at long-term interest rates, they're roughly about 150 basis points. If you think a 5-year rate, for example, 150 basis points lower than a 1-year rate. So we've already seen those long-term rates come down in anticipation that we're approaching sort of the peak for the overnight rate. But and really the question going forward for businesses is like, should I expect long-term rates to decline anytime soon? And I would argue that perhaps we've seen as much as we're likely to see in 2023. Now, I definitely can see long-term rates, a 5-year rate, for example, come down another 25, 50 basis points. Absolutely, in 2023, it's entirely possible. But for the most part, we've seen what we had to see. And the idea is that if you stick with short-term rates, there's always the likelihood, or so not the likelihood, but certainly the risk of seeing rates move a little bit higher if inflation's not responding to what we have currently, right? There's still upside risk in terms of higher interest rates if indeed inflation doesn't come down. We think it will, but there's always a risk. So I think it's those things that businesses should evaluate and then balancing the higher short-term rates versus some of the lower long-term rates we have currently in the marketplace.
Interesting, though. Interesting also to know that at this time last year, 12 months ago, we were talking about the possibility to lock in rates for up to 5 years and at quite a low rate, much lower than what we're seeing today. So obviously, things do look very different now. So given that interest rates have evolved quite considerably, we asked Bobby Singbell, a senior relationship manager in FCC's Swift Current office, what he would consider critical steps for a business in evaluating interest rate decisions.
This is a good time to review your operations' sensitivity to rate increases. Established operations with stronger cash flows can manage and adjust to those variable rate fluctuations. However, if you've just taken on a larger expansion, you may want the certainty of a fixed rate so you have the ability to plan for other unknowns in your industry. Regardless of the situation, knowing your operations' financial ability to withstand these higher interest rates and knowing your risk appetite can provide you with some clarity in this changing rate environment. Thanks for having me, and back to you, Darlene.
Thanks, Bobby. It is also of critical importance to evaluate loan structure within a business. So we asked Denton McGregor, a senior relationship manager in our Saskatoon office, to share his insights on this topic.
Hey everyone, thanks for having me. As much as interest rates are integral and important in your business, I think proper structure is equally or more important for you to achieve your dreams. What I've done with my customers for the past 15 years, and they all say the same thing, is they want to grow their business. So what I've done is I've built that right into their loan structure. And so I'm not talking about equipment debt and things that depreciate that need to be replaced. You can't use that to grow your business. That's a staple. When I look at the term indebtedness that you carry on your business and on your farm, what I like to do is structure approximately 15% of your payments to fall off in 3 to 5 years. Now, when that debt servicing falls off, you have the ability then to reinvest back into a revenue generating asset such as land, quota, cows, infrastructure, however your business is built. And it allows you to keep growing naturally just with debts falling off. The other thing is during times of uncertainty, this is farming. There's input costs that are increasing, such as interest rates, there's labor shortages. It also allows you to sleep well at night, knowing that you're going to have a payment fall off and that it doesn't need to be replaced in the future for growth. It just gives you that other mechanism. So a couple of tips from me. Thanks for having me. Take care, everybody.
Thanks, Denton, for those great tips. Now, JP, you talked about one of the business challenges as being tight labor market and how that still is one of the sources of inflation that we're seeing today. So what are your forecasts for the evolution of the labor market and salaries moving forward?
Yeah, we've already mentioned labor a couple of times, in the videos here, and so definitely an issue. I mean, one of the statistics that we like to monitor is what we call the job vacancy rate. And when you look at all levels of the food supply chain, you start off with input suppliers to the farm level. If you look at primary production, food processing, food services, even industries that are connected partly to the agri-food supply chain, like trucking, transportation, and so forth. All of these industries are showing a job vacancy rate higher than the average for all of the sectors in the Canadian economy. So to me, that speaks that we have a real issue, a real challenge in front of us that we're going to have to address with a number of different strategies, on the labor front, retention, so forth, automation, and so forth. And as a result, and because we don't expect the situation to improve much, right, when it comes to the tight labor market with the low unemployment rate and so forth, and we got high wage pressures. And that fuels inflation a little bit, for sure. And on top of that, that creates challenges for businesses in terms of profitability. So I do think that labor, to me, is one key area to watch in 2023. If we're fortunate, we might see the labor market evolve a little bit to the benefit of businesses that are looking to hire. But I would expect that, prepare for a tight labor market in 2023.
And I suspect that many of the operations will also look to innovate and adopt new technologies to be able to alleviate some of those pressures that we're seeing in the labor market. So great. So let me turn it now to two FCC experts to hear their thoughts on strategies that business owners can implement when faced with labor shortages. So we'll hear from Mark Van Vliet, a Senior Relationship Manager in Ontario, and then from Sarah Dobson, a Senior Relationship Manager on our Alliance team.
Hello, everyone. There are three things that I see my customers trying to do in order to help mitigate the current tight labor market. The first and most obvious one is to automate. But the cost of the machines themselves is not the only cost. It's the cost of the infrastructure surrounding the machines the customers have to also factor in. Stuff like ventilation, electrical, and clearing the actual floor space for the installers to come. If any of this is delayed, then it will lead to costly overruns. Secondly, I see some of my customers paying a premium for locations that are located close to public transportation. A third mitigant is for companies to try to do everything possible in order to minimize employee turnover. One of my customers went from a 5-day work week down to a 4 in order to help the employees save on their commute time. Another customer, a chicken processor, implemented an employee purchase program along with employee appreciation days. I hope this provided a bit of insight.
I would like to share 3 areas that we have seen companies focus on in these tight labor conditions. 1, the information that they are sharing. 2, the connections they are creating. And 3, the monetary incentives they are providing. Job ads are key when considering the information that you are sharing. Ensure they are concise and contain key information. Page-long job ads with excessive details have never caught anyone's attention. Keep your details relevant and ensure you are focusing on why they should choose your company. Titles are also important, especially when recruiting non-industry personnel who may not be familiar with industry jargon. In terms of creating connections, we are seeing companies spend more time connecting one-on-one with potential candidates on an Indeed or LinkedIn type of platform. We are also seeing these companies develop their brand across various platforms, with TikTok being very effective. They are spending more time developing relationships with colleges, universities, and industry groups to support their overall recruitment process. In terms of monetary incentives, we are seeing companies focus on their internal referral program for friends and family, increasing the value of this offer, and prior to a key busy season, doing hiring blitzes where these incentives may be doubled. We are seeing companies eliminate the wait period for new employee benefit programs. And we are seeing companies increase the value of scholarships offered at various post-secondary institutions, with some even starting at the high school graduate level. Thanks for your time. I'll pass it back to you, Darlene.
Thank you, Sarah, and thanks to both of you for those very insightful strategies. So JP, I remember from a previous conversation, let's talk about the Canadian dollar here, that you said that the two factors that really impacted the value of our dollar were interest rates and oil prices. So can you give us a little bit of insight on how our loonie will be compared to the US dollar in the next little while?
Good question. I mean, I always say that, overall, general statement is that we're better off in a low Canadian dollar environment. And of course, you can find examples of businesses looking to, for example, buy equipment in the US and would love to have a little bit of a stronger Canadian dollar to lower the purchase price and so forth, right? But overall, general statement, rule of thumb is that we're better off in a low loonie environment. And we have, for the most part in 2022, see the Canadian dollar decline, right? So you'll see on the screen a chart that looks at the pattern in the Canadian dollar relative to the US dollar, as well as provide a forecast for 2023. Now, the one thing I'll say is that we do expect to have more volatility that you see up on the screen. I think the story behind the forecast for 2023 is that we expect a lower value in the first 6 months of the year and a higher value of the loonie in the last 6 months of the year. I think that's what's important to obtain from the chart here, is that not necessarily the value itself, but the fact that we expect the loonie to decline in the first 6 months. And that's entirely driven, as you alluded to, by the state of the global economy. There will likely be a global economic slowdown of some kind. We've seen central banks across the world, it's not just happening in Canada and the US, raise interest rates to rein in inflation in all parts of the world, really. And so that should, in and out of itself, slow down economic growth to the point that perhaps the demand for oil could slow down as well a little bit, and that explains sort of the drop in the first 6 months of the year for the loonie in our forecast. When it comes to interest rates, you're absolutely right. I mean, it matters, right, the rate differential between the US and Canada, but we're not seeing much differences there, for most of 2023. So at the end of the day, it's all about the health of the global economy, and we expect it to be a little bit weaker for the first 6 months, a little bit stronger towards the end of the 2023.
A little bit of optimism there.
At the end, yeah.
Great. Okay, so let's change gears here. So I'd like to dive into a few sectors of the agriculture and food industry and look at the profitability for 2022 and 2023 moving forward. And I'd like to start off with the grains, oilseeds, and pulses. And for this, I'll welcome Desmond Sobel, Principal Economist with FCC. Thanks for joining us, Des.
Thanks, Darlene, and thanks for having me. I guess if I was to sum up 2022 into one word, it's volatility. There have been so many factors that have affected commodity prices this year. Supply chain disruptions that JP talked about, while they're improving, they're still persisting. We've seen weather events, and as well, we've seen low global stocks-to-use ratio. And I'll talk a little bit more about that later on. But I would say the biggest factor that impacted 2022 was the Russia invasion of Ukraine. It caused upheaval in commodity markets. We saw record high commodity prices for most, if not all, commodities. And as well, for the entire year, prices were well above the 5-year average. But the other thing that happened with the invasion was food security. It became front and center for a lot of countries. And so when we saw that, it actually created some changes in geopolitical alliances and some changes in trading patterns. It'll be interesting to see if that continues on beyond the Russian invasion, but it's something to be mindful of. Yet, despite all this volatility in 2022, producers had a great year. Prices were high, so they were able to get good returns on their product. For 2023, we're expecting volatility will continue, but we won't see it at the same pace that we saw in 2022. Even though the war still remains a major wild card for ag markets. As well, JP alluded to it, the prospects for an economic slowdown, that looms over the sector. But we're cautiously optimistic right now. So overall, 2023 is going to be a strong year. We're seeing there will be strong revenues, and so that's something good for the ag sector and crop production. And as always, Darlene, we're paying close attention to the weather. The impacts of a drought on yields and production is something we're always being mindful of. We don't have to look too far back to 2021 and the drought on the prairies. That was severe, and it just showed you how things can change really quickly.
Yeah, so many factors that impact commodity prices. It's just lots to look for. Okay, so while we focused on commodity prices, no, actually, one more question. I'd like to dig deeper in the global, when we look at commodity prices globally and the global crop production. Do you see any of the countries that stand out and that could ultimately have an impact on grain prices for producers here in Canada?
Yeah, for sure. Before we get into that, though, I want to talk a little bit more about stocks-to-use ratios. And so, with the prospect of an economic slowdown, we're saying that we're still seeing a strong demand for food. People still need to eat. So this demand is driven by what I talked about before, is food security, as well as the low global stocks-to-use. Looking at the stocks-to-use chart that's going to appear shortly, we can see there's excess demand for current production. And so this has resulted in a decreasing stocks-to-use ratio over time. And what this really means is that if you look at corn, for example, or coarse grains here, the stocks-to-use ratio is about 26%, and while for wheat it's about 34%. This really means that 34% of the wheat available this year will be left over after the total use is tallied. Obviously, the lower the ratio, tighter the supplies, the more upward pressure on commodity prices. So, however, if the economic slowdown is more severe or more prolonged than we expect, that will definitely have a drag on commodity prices.
Okay, so let's go back to my previous question around global crop production. So are there any countries that could actually impact the price of grain production for producers here?
Yeah, so for sure. We've been really watching what's happening in Ukraine and the Black Sea region. So we know they were having trouble getting exports out of the Black Sea, that area, with some of the ports and the issues they were having with the war. But we don't want to overlook South America. Brazil and Argentina are two of the world's largest producers and exports of ag commodities. So in 2022, the two countries shipped a total combined 57% of total global soybean exports, just under half of corn, and about 5% of wheat. So it's fair to say that these two countries, and South America in general, can have a huge impact on commodity prices globally, which will impact Canadian producers. The other thing to remember, which is really, really interesting, is Brazil can actually double or triple crop in a marketing year. So what happens in South America does have a huge impact on global commodity prices. What we're seeing right now, Argentina is having one of the worst droughts in 40 years. That's going to impact yields and production in Argentina. There's soy and corn. But Brazil, on the other hand, has precipitation has been timely, and their crop production is actually expected to be fairly strong. So overall, it's a bit ambiguous what's going to happen in South America, but it's definitely something we want to keep an eye on.
Absolutely. Looking forward to see what's going to happen there in South America and the impacts that it will have. Okay, so while we've focused on commodity prices so far, we know that expenses continue to be top of mind for producers. So what are you expecting for 2023 on this front?
That's a great question. So far we've covered off the revenue side of the equation. So now we want to focus on expenses. And if you look at the following chart here, we can see how dramatically farm input prices have gone up from 2021 to 2022. 2022 was pegged as the most expensive crop ever put in the ground. And that's largely driven by the massive increase we've seen in fertilizer and fuel. For 2023, we're expecting increases, but more moderate, in the low single digits. So prices are still going to be elevated at a rate, but not compared to what we saw last year. So when we look at overall crop expenses, for the prairies, total expenses we're forecasting will be about 5% higher for a canola wheat rotation, while in Eastern Canada, we're saying total crop input expenses will increase about 13%. And that's for a corn and soy rotation. So Darlene, it's fair to say 2023 will now be the new most expensive crop put in the ground.
So one of the things that businesses do have control over is the efficiency within their operation. So for this, we've asked Melissa Reinhardt, a manager of business development in our Calgary office, to provide some insights from the field on this topic.
Hey team, thanks for having me. This is a great time of year to review your past year and plan ahead for the new year. One tip is to focus on efficiencies. Identify the things you can or can't control. A tool to help you with this is benchmarking. Benchmarking is the practice of measuring your operation against others of similar size or location. This is a great tool to use during planning as it helps you identify your strengths and look for areas of opportunity to make adjustments. FCC has developed a benchmarking tool that measures profitability, efficiency, and leverage on a per unit basis for cash crops and dairy producers. If you're interested in accessing this tool, be sure to talk with your local relationship manager. Thanks, and enjoy the rest of the session.
Thank you, Melissa, and thank you for mentioning that FCC benchmarking tool. So this tool is currently available now for the grain and oilseeds and the dairy sectors, but we are working towards making it more accessible to other sectors sometime in the near future, so stay tuned for that. I'm going to switch topics, Des. I'd like for us to talk about renewable fuels, and more specifically, renewable diesel. So I feel that there's a real opportunity here for Canadian grain producers. And what are your outlook for the oil seeds and vegetable oils for 2023?
Darlene, we're expecting the demand for these two commodities to increase over the coming, this year and into the future. This is being driven largely by biofuels mandates in both Canada and the US. So that's going to support prices. But as well, it's not just Canada and the US. North America, other countries around the world also are introducing mandates, and as well the demand for edible oil for food sources. That's going to continue to drive those commodity prices higher and higher into the future. So, as a result of this, Canada is building its renewable fuel capacity, and as well in the western provinces, there's been a recent announcement in 2022 for a lot more canola crush plants. So this is going to help local oilseed producers. It's going to support prices, and it's going to provide those opportunities for more local sales and domestic demand to be met by our local customers. So bottom line is, the mandates around the world are really boosting demand and supporting these commodity prices. And what we've seen overall, when you tie this all together and look at the revenue and expense side of it, we're seeing margins in 2023 that are going to be fairly positive for both Eastern and Western Canada. They won't be as high as 2022, but they're still high and they're still well above the 5-year average.
Good. So in summary, I guess we could say that expenses are going to remain elevated in the grain and oilseed sector, but higher commodity prices should offset these higher expenses.
Exactly.
Great. Okay, so for livestock operations, we've seen that they also are impacted by inflation. And I'd like for us now to review a few of the economic drivers for livestock production, and we'll start with the hog sector. So JP, based on what we've just heard, I suspect that the most critical profitability factor here in livestock production is the cost to feed the animals. So I'd like to see what you can tell us about the trends in the hog production sector for 2023.
Yeah, so for sure. Feed costs, most relevant profit driver in the sense that, lower feed costs would help support profits. And if you look at 2020, if you start off with 2020, I believe feed costs at the time were about, in hogs, they were about 60% overall costs, and they went up all the way to 66% of total costs, feed costs, that is. 66% of total costs in 2022. Now, we expect that to come down slightly in 2023 to 64%. So a little bit of relief on the feed side for hog operations, which is a good thing. We'll bring up on the screen a chart representing profitability trend expected for 2023 for hogs. And that's really just the hog price to corn price ratio, right? And if you look at, the 2023 forecast, that it's the dotted line up on your screen on the far right of the screen, well, we're looking at, overall for the entire year, roughly, overall average profitability for the year. So I do think that we're likely to see, and it's trending up according to the usual seasonality patterns as well that we should expect from the sector. So overall, prices will help, hog prices will help support some profitability. We do expect, though, that maybe hog prices could come down towards the end of the year. So this is maybe an area to watch out. But feed costs, I would expect a little bit of relief. And if you look at our index of feed costs for the hog sector, it is projected to come down slightly, about 8% from 2022. So a little bit of relief on that side.
Okay, and your projection of lower hog prices in the future, what do you see is the reasons for that?
Yeah, well, in reality, I have to say that I would think that futures markets would see or would show a little bit of a higher hog price right now. I mean, if you look at the USDA projection, and so it's all about supply and demand, right? So if we start off from supply, you look at 2023 projections, the USDA projects that supply of pork is going to go up slightly, just barely. If you look at the breeding stock in the US, it's off the peak of 2020, lowest point of about 6.5% off the peak of 2020, lowest point of the last 5 years or so. So in essence, it's really hard to see a big rebound in production coming from the US. And so if it's not, supply or higher supply that is likely to cause prices to come down, it needs to be on the demand side. On the demand side, we alluded to a number of times already to this global economic slowdown, but pork meat is usually quite resilient in the export market, quite resilient to economic or the world economy slowing down and so forth. So it might not be that we see export demand weaken as the world economy slows down a little bit, but I do think it's coming out, sort of the question marks are coming out of China. So if you go back to maybe a couple of days ago last week actually, China released the numbers that came out of China. Their numbers suggested that pork production went all the way up to 55 million tons in 2022. Now, just to put this in context, 55 million tons is already higher than the projection of growth from the USDA for Chinese production in 2023. So they ended up the year, according to their numbers, higher than what the USDA and everybody else was projecting production to be in 2023. So it's a little bit of a surprise. Now, I get it, right? We have to exercise a little bit of caution around numbers coming out of China. So that's for sure. But nonetheless, I mean, 55 million metric tons is the highest of the last few years, certainly higher than what going back to, or as high as going back to the days prior to the African swine fever virus that decimated their pig population. So all in all, I think there are a lot of question marks coming out of China, largest pig producer, larger pork consumer in the world. It's a good market in the sense that we hope that the economic activity in China will resume, and that will create export opportunities for Canada and other suppliers as well. But there are lots of question marks as well in terms of their ability to move away from their zero COVID policy. I mean, like, it creates a lot of enthusiasm for possible growth, but it creates also lots of question marks as to how this is going to evolve throughout the year. So a little bit of caution there, and hopefully demand doesn't weaken too much, and we see hog prices maybe a little bit higher than what currently futures markets are suggesting.
Hopefully, for sure. Okay, so I'd like to turn now to another red meat sector, and we're going to be talking about beef. So in 2022, we saw some strong prices for cattle, both the fed and the feeders. However, with high feed costs, feedlot margins were pressured to below the 5-year average. So has anything changed heading into 2023, Des?
Short answer is yes. So JP already alluded to feed costs have come down. They started to soften, and you'll see the chart showing up on the screen here for fed and feeder cattle futures. So heading into 2023, we're still seeing strong prices that are above last year and are trending in a positive direction. So this is going to be good news for feedlots and a higher return to profitability in 2023. The one watch item that JP's alluded to and mentioned over a few times already is the economic slowdown. What's this going to do to the demand for red meat? And so in theory, as an economic slowdown, you'd see people consuming less beef. But our analysis actually shows that beef is, given the high cost of other protein sources, beef is actually an affordable option. So despite this, there's still going to be strong demand for beef despite the economic slowdown.
Yeah, and we know that south of the border, U.S. has an impact of what's going on down there, could have an impact on our cattle, our beef sector. So do you have any thoughts on any possible problems coming out of the U.S. that may impact here?
Yeah, definitely. So right now, the U.S., a third of the U.S. is facing a moderate to severe drought. And if you focus in the Southern Plains region, which includes the Texas heartland, the drought conditions are what they called severe to extreme. So if the chart that's going to show up here shortly, what we've seen in the U.S. is more heifers and cows are being slaughtered due to a lack of feed and water. But Canada's not immune as well. So the 2021 drought that I alluded to earlier has had an impact on Canadian beef producers as well. So in 2022, the number of heifers sent to slaughter as a percentage of total heifers reached an 8-year high. We're projecting for 2023, this level is going to increase, and it's going to be at a level we haven't seen in over a decade. So long story short is, both in Canada and the US, there's going to be a struggle to build herds again. And so as producers start to keep more heifers, we're going to start to see that cut into cattle available for feedlots and for slaughter. So bottom line is, feed prices are going to remain strong for the first half of the year, and then they might soften. But overall, the good news is feedlot margins should be fairly positive and a higher return to profitability. And this should encourage expansion in the future as well. So overall, Darlene, there's some much needed optimism in the beef sector, which has not been there for a while.
Absolutely. So I'm sure they're looking forward for that for this industry. Absolutely. Okay, JP, let's now talk about dairy. So what do you see as the most relevant trend to monitor in this sector?
Well, I think some of you might have guessed. I'm going to focus first on cost, because I think that's part of the theme in 2022 and will remain an important driver or impediment to profitability in 2023. We'll put up on the screen really shortly here an index of cost production for dairy operations. And really, I think the takeaway is higher costs in 2021, higher costs in 2022. And we expect that those costs, and you'll see up on the screen in a second, that those costs in 2023 are going to remain elevated, but not go up, right? So the higher costs that we had in 21 and 22, they were partially offset by a higher milk price. I mean, let's face it as well, the increase in the milk price did not offset all the additional costs. And so farm operations or dairy operations have had to find efficiencies within their operations. But the bottom line is that with costs remaining elevated, but not projected to grow, I think that's consistent with the increase in the support price of butter effective February 1st. That is expected to generate an increase in the milk price at the farm level around 2% or slightly higher than that. So bottom line is costs will remain elevated. We're going to get a little bit of relief on the milk price, and that should protect some of the profitability trends that we've seen for the last couple of years.
So we really see that common thread in the livestock sector around the higher cost of feeding and how it impacts profitability. Okay, so another driver of profitability is the trend in the production of milk, specifically butterfat. So could you talk to us about your expectation when it comes to the milk requirements on the domestic market in Canada?
Yeah, it starts off with consumers, really. It starts off at the retail level with demand. And so if you look at demand for most of 2022, it's been really resilient. I mean, we have currently some strong inflationary pressures, but it's true across the entire food supply chain. Perhaps butter is a little bit above the average of 10% that we highlighted at the very beginning of this presentation when it comes to food inflation, but most of the other dairy products are right around the average of 10%. So I think that dairy protein is right around the average. And for the most part, 2022 has been a resilient year when it comes to demand. Now, the one thing that makes it hard to forecast and project into the future is that we've had lots of disruption in the dairy sector following the pandemic, right? 2020, 21, even 22 to some extent, have seen patterns of consumption change a little bit. And this is really the hard thing to project when we're thinking about 2023. But I see some resilience at the retail level, and I think that should sustain a strong demand, or demand that is at least as strong as it was in 2022. Now, imports are another wild card in the sense that we expect more imports in 2023. The U.S. has launched a dispute resolution process, not really happy with what they're seeing in terms of the imports coming into Canada, coming from the U.S. We'll see how that gets resolved. But the bottom line at the end of the day is that some of the import levels that we've seen in 2022 were the result of a low Canadian dollar that made imports expensive. So it's not entirely surprising that we've seen lower imports than perhaps we should have expected or we would have expected. We'll see how that plays out in 2023, but I'm not seeing imports climbing really fast in 2023. So that's another positive for production domestically. And finally, the stocks of butter currently are really low. And so we're going to have to rebuild that. And so all of that together, I do think that this is going to trigger increases in production throughout the year in 2023. And our forecast currently is between 2 to 3% increase in overall milk production for 2023. So that should, on top of a small increase in the milk price, that should boost revenues in dairy for about 5 to 6%.
Great, thank you. Thanks for that, JP. So we've reviewed a few of the largest ag sectors, and I'd like to now put focus downstream in the food supply chain and discuss the outlook from the perspective of food processors. So sales are projected to go upward, and I suspect there's quite a bit of variability in the sales sectors across the different sectors in food processing. Do you want to tell us, Des, what you think that some of those sales projections will be?
Yeah, so first thing, inflation is impacting the food processing sector. The food sector's, JP showed the slide earlier, food inflation is still really high. And we're seeing that as, it was in the news at the end of 2022. In early 2023 thus far, food inflation is the #1 news story. And so this is impacting food manufacturing sales as well. So while sales are still going up, they're going up more moderately. And so for 2023, sales we're saying are going to go up about 5.7%. And this is with still robust demand. And so we're having the strongest population growth we've seen in decades in Canada. This is driven by two factors. One is increased immigration. And we know that's going to take some time. That's one of the strategies of the government, is to increase have more immigrants in Canada, which should help the labor pool as well. And the second is increased birth rates. So this is something we haven't seen in Canada in decades. And it's actually, what's interesting is actually boosting infant food sales. So, this increase in demand is dependent though on inflation. So we're seeing consumers shifting their patterns. So they're moving away from the higher value added goods to lower price substitutes. They may be changing their purchasing habits from brand name to no name goods. So that's going to put some restriction on sales as well. What we've seen in the sales in 2022 is really that's being driven by inflationary pressures, with volumes being fairly flat.
Great. Okay, so I imagine that that'll be variable across the different sectors for sure. And we'll have to wait until March when FCC releases its food report to get all those details on this. And the sales that impact, the revenues is only part of the profit equation, yeah. Right? And it's really, what are your expectations when we talk about profit margins and the expense from the expense yeah. perspective?
So in 2022, we showed that sales had gone up, but margins actually went down. And this was largely due to higher costs, higher wage costs, higher costs for raw material inputs, and the supply chain disruptions that impacted the food sector. So margins came down. So for 2023, though, we're saying sales are going to go up modestly and margins are going to improve slightly. We can see here, year over year, we got a slight improvement in margins. The one caveat to this is that consumer and what their spending habits become. As they try to stretch their dollar a little further, they're going to choose more wisely in the aisle. They're going to maybe pick and choose a little more. I've even heard that some consumers are going to choose to consume less food. So this is all going to weigh on the sector, but we're still seeing some positive growth, just not as strong as we've seen historically. But overall, I would say, Darlene, margin increases will be a combination of lower commodity costs and higher selling prices.
Great. So pressures on margins are real for a variety of reasons. And we asked Bonnie Bain, a senior relationship manager at FCC's corporate and commercial team in Winnipeg, to discuss the impact of supply chain disruptions and high input costs on food processors.
Yeah, for our corporate and commercial customers in the agribusiness and agri-food sector, the rising input costs coupled with supply chain issues has been a real double whammy for them. We're seeing companies move from that, just-in-time type of strategy for their manufacturing to a just-in-case, making sure they have the supplies on hand. So that's caused rise in their inventory levels, which costs more cash to be tied up, costing the company more money. So it really has been quite a challenge. What we're seeing, the successes that our companies are seeing is having a really strong relationship with your primary suppliers. Building a strong relationship is a lot easier for a company to work through some of these challenging times, but at the same time have a secondary backup supplier and build that relationship with them so that you have two options available to you. At the end of the day, if all else fails, we are seeing some companies take advantage of the opportunities right now in the marketplace and vertically integrate. So they're looking at buying their suppliers, their key suppliers, so that they know that they have that supply of that key input that they need. And that has allowed them that control and mitigate that risk for them.
Thank you, Bonnie. Great points on the diversification and integration. So now let's hear from Alex Lau, a Senior Relationship Manager on our corporate and commercial team in BC, as he highlights a few other strategies to consider in response to the elevated operating costs.
The best use solution is to have frank and open conversations with your customers. Everyone knows that inflation is high, and if they're your long-term committed partners, they will allow you to increase prices to offset these costs. Other solutions include looking to buy local so that you can decrease the distance between your raw materials and your operations and decrease your freight costs. If that's not possible and your products must be shipped from overseas, I've seen customers increase the volume by which they buy at so that shipping is done less. Other customers have looked at retooling their production process in order to decrease wastage, and other clients have also looked at changing the way they either grow or manufacture their product to look at finding options for lower cost inputs.
Great insights, Alex and Bonnie. You both have given us a lot to think about on those strategies. So Des, if you had to identify one determinant trend for processors to monitor in 2023, what would it be?
Labor. The labor market's still tight. JP went over labor in detail, but it's not going to recover anytime soon. So processors are going to have to make that decision. Are they going to need to pay higher wages to attract labor, or are they going to have to look to automate? At the end of the day, though, both of these options will increase costs and pressure margins. So this is really something that they have to keep an eye on and look for those opportunities to find efficiencies to make sure that they can still have positive margins.
An ongoing challenge for sure. So folks, that's it for our 2023 FCC Economic Outlook. A recording of this event will be available for those of you that have registered. So if you missed any piece of information, you can go back and watch it again. I encourage you to keep checking back on the FCC website at fcc.ca, and you can go to the Knowledge tab and then click on Economics. Within there, you will find top economic charts, forecast of farm income, and sector outlooks. The list of resources is very long. So with that, again, thank you for joining us. On behalf of all of the FCC staff, have a very successful 2023.